One of the things you hear me talk a lot about in these Jedi Options segments is the link between the probability of profit, the likelihood you're actually going to win, and the amount of money you win. And so this runs the gamut where you can find trades where you have a very high probability of profit, like 90%. Okay. But you're not going to find a trade where you have a 90% chance of making a 90% return. It doesn't exist. Return on investment and probability of profit reside on opposite sides of the teeter-totter. As you raise one, you lower the other. As you raise the other, you lower the first one. So in this case, high probability is going to correspond with lower payout. Okay, lower payout. As you look to increase the potential return, of necessity, it will lower the probability of profit. So I kind of draw this out as like a scale where you see that just the general relationship between the two as you again raise one, you lower the other. Okay, and the reason this is helpful is because in the options market, you learn tons of strategies, and it's like, well, how do I pick the right strategy for the right situation? That's part of that's part of the game when you're trading options is trying to improve your positioning and picking the right strategy for the right time. And you can try to make the decision multiple ways, but I like to view it from this little scale here. We're talking about bear trades, okay? Again, the motivation here is the market went down 4 straight days. We broke the 20-day moving average yesterday. I downgraded my bias a little bit, okay? Not crazy, but a little bit. Listen, the market is not as healthy as it was after Jay Powell's fireside chat with his friends on November 30th, okay? And so, maybe I'm in the mood for doing something slightly bearish. Well, if I want a high probability and I'm willing to accept a lower payout, I'm thinking bear call spread, okay? If I want to shoot the lights out and bet the market's going to implode and have a very high return on investment, I'm going to go buy a put option. Okay. If I want something a little less aggressive, that has a better probability, and I'm willing to lower the payout a little bit, I'm going to do maybe something like a bear put spread. Okay. If I want something a little more aggressive than a bear put, but not as aggressive as a long put, maybe something like a put butterfly out of the money. Okay. Well, the put calendar spread fits kind of right here on the scale. Put calendar. So my thought with this, and I'm going to have a bear of a time limiting this conversation to 10 minutes. I'm going to do my darndest. Okay. But I like in my strategy playbook to have kind of an organization of understanding when I would do one strategy versus another. What pointed me towards a put calendar as an appropriate strategy for the current market conditions is, number one, I don't want to go aggressively bearish because I don't know that the chart warrants it yet. That says no to long put butterfly, and bear put, because their lower probability essentially means that you need the market to drop a decent amount. Okay. And I don't really want to make that bet. All right. But at the same time, the bear call spread needs higher implied volatility, expensive options. And we don't really have that right now. The reality is the VIX has gotten smushed. It's gotten smushed over the last 2 months as the market has rallied. We're at the lower end of the 2022 range. So you can certainly try to sell bear calls. You're just not going to get paid that much. So using process of elimination, I knocked that one off the list. And it just so happens that a put calendar has low implied volatility, or it's a positive vega trade that benefits when implied volatility rises. Okay. And so I'm like, all right, I don't know. I feel like put calendar checks the box. I feel like it checks the box. So that was kind of how I thought through that being an appropriate strategy right now. Now, what is the structure of a put calendar? Right? What's the structure? Well, the idea with a put calendar is you buy usually an out of the money put. And I usually go out a couple of months. So I'm going to buy like a 2-month out of the money put option. And then I'm going to sell a 1-month out of the money put option against it. And this is going to be a horizontal calendar spread. It means you buy and sell the same strike. Okay. So buy the 2 months, sell the 1 month of the same strike price. And I essentially need to find a stock that I am neutral to bearish on. And honestly, I think I think a lot of people overcomplicate this, and it's like, listen, man, if you want some bearish exposure on the market, just do it on the market. Let's just do it on the S&P or IWM or the Nasdaq or something. So we did it on SPY last night. We used SPY, and in choosing how far out of the money to go as you structure this put calendar, it's a preference thing. If I set up a put calendar down at 370, 370 is my target. I need the S&P to get down to 370. Okay. If I set it up at 380, then 380 is the target. If I do it at 385, then 385 is the target. So it's like, well, how bearish are you? Are you like on Team Grinch here, and you think we're going to implode into the end of the year? Then maybe you want to do a more, further out of the money put calendar. Okay. Me, I'm not on Team Grinch. Okay. It's Christmas, for heaven's sakes. Got a good attitude. I've got an optimistic outlook, despite what the last 4 days has done to me. And so I'm like, let's just go slightly bearish. Let's just go slightly bearish, because I'd still like to set up a profit range where I still win if we go sideways. And you can't do that if you set up a 370 put calendar. So last night we were looking at like 385, 384, 383, and I ended up about 382 because that's right around the 50-day moving average. Okay. And I will tell you that generally the short put has a delta around maybe 30 to 35. So I'm not way out of the money. I'm a little bit out of the money, right? So what we're going to do is we're going to buy a February 382 put, and we're going to sell a Jan 6th 380 put. Usually I like to buy 60 days and sell 30 days, but there's not a good 30-day option, or at least there's not actually a 60-day option right now. I can get a 30-day on the short side. Can't get a 60-day on the long side just because of where we're sitting with the cycles. So February is like 72 days out. Jan 6th is about 30 days out. So it's close. And what it's going to do, let's go to the trade tab. What it's going to do, here's my Feb. Right there, 72 days out. I'm going to buy the 382. Okay, slightly out of the money. And then I'm going to sell the right around 30 days, in this case, Jan 6th, 30 days on the nose. Same strike, 382. And you can see this has about a 30 delta. Got about a 30 delta. So let's sell that. $5.19. $5.20. Okay. If I analyze it, got a few of these on there from last night. Let's pop those off here. Here's what the risk graph looks like. Okay, you got this nice little tent. And the peak of the tent, which is the max profit, is the strike price you chose, which effectively means that's the target. Now, that dotted brown line is the current stock price. So a couple of things to notice. Number one, the tent peak is below the current stock price. So I want the stock to head down towards 382. Okay. If it doesn't, and the stock just goes sideways, it's still in the profit tent. At expiration, I'm making $168 at the current price. Okay. So I'm slightly bearish. Now, if the market implodes, this could potentially lose money. I don't want it to implode. There's going to be plenty of time, though, for you to take profits before you start to lose if we go lower. So the best case scenario is that the market meanders, maybe pulls back a little bit, and time passes. Remember, the Greeks tell you how you're making money. The delta is negative. You're slightly bearish. The theta is positive. I'm making money due to time decay. The Vega is positive. So if I can get a bump in volatility, which should happen if the market goes down, that's going to help me too. So really, I just want, for this particular play, S&P, do what you want to do, man, but work your way down towards 382 over the next couple of weeks. And simultaneously, I want the VIX to pop.